Hello, clients and friends. This is Tony Ingracia from Wealth Management Strategies, and it's my pleasure to present to you our first quarter economic review. As you watch this, please keep in mind it's a review of the months of January through March. Since then, April has presented some very challenging times for investors, so I'll be addressing that at the end of the short presentation. So let's begin. At our firm, we partner with clients and believe an educated client is the best client. While we always try our best to help you with your finances, we believe knowledge is power. And not only being knowledge power, but applying that knowledge as well. One of our missions is to share any knowledge with our clients and help you make better informed decisions. As you can see from the charts, the first quarter was a roller coaster ride for investors. We entered 2025 with continued strength from 2024, and in mid-February, equity markets made another round of all-time highs. But then after two robust years for equities, investors' sentiment quickly did an about face. Uncertainties and changes quickly dominated the headlines, and equities experienced a quick downfall during the last 6 weeks of the quarter. The transitional period between new administrations typically brings adjustments, and with those changes comes volatility. As promised, the United States, the new administration, has an aggressive agenda, and President Trump's first priority was to implement quick and sweeping changes. Equities reacted to the uncertainty during the quarter by going near or into correction territory as investors became concerned, especially over the global trade wars, new tariffs, and the effect on the economy. At the first quarter's end, the S&P 500 was down 4.6% year to date, and the Dow Jones Industrial Average was down 1.3%. Good news arrived with better than expected inflation numbers, which showed that U.S. inflation decreased to 2.8% in February, down from 3% in January of 2025. The core CPI, which includes food and energy prices and is often viewed by economists as the better gauge of future inflation, was at 3.1%. The increase in sheltered costs in February accounted for nearly 50% of the overall CPI rise. Now, while inflation is gradually moving towards the Fed's 2% target, we are still not there yet. After reducing the federal funds rates 3 times in 2024, the Feds felt it appropriate to keep rates stagnant at 4.25% and 4.5% at both of their first quarter meetings. The Fed is attentive in monitoring key economic indicators, including labor market conditions, inflation pressures, and expectations, as well as financial and international developments. With 2 Fed meetings scheduled for the second quarter and 4 more planned for the second half of the year, the Fed has indicated that further rate cuts will be contingent upon inflation trends and economic conditions. Now, bonds have an inverse relationship with interest rates. When one goes up, the other usually goes down. Yields ended the quarter slightly lower than where they started. On March 31st, the 10-year note was 4.23%. The 20-year Treasury ended the first quarter at 4.62%, and the 30-year note closed at 4.59%. The current outlook for bonds in 2025 remained unclear. Uncertainty about interest rates, inflation trends, and clarity on tariffs currently remain. Therefore, you could expect bond yields to fluctuate. Bonds can be a part of a well-diversified portfolio because historically they are lower volatility than stocks. The transitional time between the new administrations typically brings some uncertainty, which leads to volatility. This new administration came in as indicated it would, and President Trump's first agenda was to make quick and sweeping change. Optimistic investors' sentiment quickly decreased as some of the more aggressive campaign promises became to materialize. Towards the second half of the quarter, investors became wary, and concerns over global trade wars and tariffs created high levels of anxiety. Now, let's briefly address the elephant in the room, tariffs. Right now, you cannot turn on the news without hearing about tariffs. But what exactly is a tariff? Are they a good thing? Are they a bad thing? Tariffs themselves don't necessarily cause volatility. It is how they are applied and how the investor's reaction to them can create instability in equity markets. Tariffs have been used by many countries, including the United States, for centuries. A tariff is a tax on goods that are imported or exported between countries. They are a type of trade barrier that can raise prices and reduce the availability of goods and services. How do tariffs work? Companies import foreign goods, pay the tariff to the government. Tariffs can be a percentage of the value of the imported product, or they could be a flat tax charged on the imported good. Now, why are they used? Tariffs are used to protect domestic industry and jobs. They can also be used to punish or discourage actions a country may disapprove of. What are the effects of tariffs? Tariffs can increase the cost of production and the cost to the consumer. They can also create tensions between countries and lead to trade wars, and they can negatively affect the stock prices of companies that they rely on for imported goods. The new administration proposed tariffs, and they became a nightly news agenda item and widely discussed topic, with sizable concerns about their potential impact on the U.S. economy. The Trump administration announced multiple tariffs. The administration feels it will protect the domestic industry and boost sales of American-made products by taxing imports from all countries. The White House suggested that these tariffs will grow the American economy, help reduce our deficit, and create jobs. The administration is claiming that the tariffs are reciprocal and discounted to the tariffs that other countries place on the United States. So during the first quarter, when these tariffs were discussed, the S&P 500 dipped into correction territory. As President Trump began getting specific and the administration was announcing enactment of these tariffs, in the first week of April, U.S. and global equities retreated in a quick and alarming way. And as of this update, U.S. markets have reached bear market territory, which is generally defined as a decline of 20% or more from the recent high. Remember, a recession is 2 quarters negative. We're not there yet, and we hopefully won't get there. But as of now, the level of uncertainty is high, and we do not know the specifics as how much this will affect the economy and inflation moving forward. We remain committed to keeping a watchful eye on these tariffs and their effects on our clients' investments portfolios. So we understand that recent volatility of the stock market is very uncomfortable. The combination of market correction and political uncertainty has been mostly helpful for media outlets who use fright as a method of attracting viewers. It's easy to become concerned and alarmed when equity markets move down swiftly, but focusing on what you can control is the most important. The nightly news can become frightening, but that's when you need to stay away from making emotional-based decisions. 3 of the major things you can control are your behavior, your risk tolerance, and your time horizon. You know, I always say, don't watch that financial pornography. It is often said that investors can lose more money by making bad decisions than they can from market declines. Short-term market movements are nearly impossible to predict. So that's why we share with clients that we believe in proactive planning and having your bucket plan strategy in place. And that is key. Your equity investments are for your long-term bucket, and you need to be prepared that in any given time, they will go down in value. We encourage you to limit your exposure to that financial pornography or upsetting media reports and news. Remembering you're invested for the long term, and it helps you stay well-grounded in times of volatility. As a recap, here's some things to remember. After 2 robust years for equities, the S&P 500 entered correction territory in the first quarter of 2025. The new administration brought many changes, including tariffs, which had a significant impact on equities, and investors have experienced a rapid downfall. The Fed held the federal funds rate range steady from 4.25 to 4.5 as of March, and they're still forecasting possible rate cuts in 2025. Better than expected inflation numbers came in, showing that U.S. inflation decreased to 2.8% in February, down from 3% January 2025. Bonds present a less volatile alternative to equities and an additional option for those looking to diversify their portfolios. Focusing on what you can control and minimizing your exposure to the news can help you stay well grounded in times of volatility. Market declines are part of the investment experience, and maintaining the consistency of a well-devised, long-term focused plan, your bucket plan, historically served investors well. And finally, remember, we are here to discuss any changes or concerns that you may have. Once again, thank you for your trust in us. One of our main objectives is keep you well informed, and we appreciate you taking time to listen and watch this update. Please feel comfortable, share this update with anyone that you may think of that can benefit from it.